You need to take control of the banking function in your life. If you've been doing any research recently on the infinite banking concept, you've probably run into this phrase and asked yourself, what the heck does that even mean? Well, in this video, I'm going to cover what that means, what it actually looks like when it implements when you implement it in your real life, because ultimately when you go online right now, there's some people who are misrepresenting and miscategorizing kind of what that looks like and using it in a way that actually doesn't make a lot of sense. So what I'm gonna do in this video is I'm gonna talk about what does taking control of the banking function of your life mean, in my opinion? What does it look like if you do it the right way? And what does it look like if you do it the wrong way? What are things to consider when figuring out, does this even make sense for you to try to do this? And ultimately, what are some pitfalls that you need to make sure you avoid? So if you haven't already, make sure you subscribe and hit the bell. That way you're notified every time I launch a new video. Let's go. Hey, what's going on, Cashflow hackers? It's Chris with Life 180, and today we are talking about taking over the banking function in your life, and what does that mean, and how do you implement it in your life? And I guess to get into this, to get started, just to get right to the dirty of it, ultimately, the idea and the concept of taking over the banking function of your life, I love the idea because it's all about control. Anytime we have the ability to have more control of the results of our life, that is a really good thing. Now, I will say this, I am not a believer in taking over the banking function of your life and utilizing my life insurance policy as a bank alternative and having every expense run through my life. I want to put this caveat out there as I get into this business, because I know this video is probably going to ruffle a lot of feathers, probably some feathers of some people that I actually really like. That said, to me, truth is truth, and I'm going to share my truth, and that's what this video is all about. And so here's the deal. I'm going to put this out there, and I want to just let you know ahead of time, not every person is doing this. This is not what Nelson Nash says, and it's just because a lot of people are taking, and there's degrees of separation to it all, and it's kind of like the telephone game where you go down and you whisper in each other's ears, like, what does take over the banking function in your life even mean? And people kind of create it and they make it their own deal. And I'll also say that I don't necessarily agree with everything Nelson even said about taking over the banking function in your life. So let me kind of talk first and foremost about something I've seen a lot of recently, and I'm going to get into this. And so that is something where people believe that you should run 100% of your income. I'll just do this. I'll do 100% of income through a policy. Now, the idea of running 100% of your income through a policy to me is just inefficient. It's not compliant. I don't know how you even get that approved through a compliance department from a suitability perspective, but I know some people say it, and I know that his idea is when you have 100% insurability on your own human life value, that's when you should start insuring other people, kids, family members, stuff like that, other people that you have insurable interest on. This can have a massive impact on your family's future, and obviously that is absolutely true. But I'm not a believer in putting 100% of your cash flow going through a life insurance contract, because there are too many variables that go into that. Furthermore, it's just not efficient, because a lot of people would say that you get positive arbitrage on a policy. Now, this is going to be a pretty technical breakdown, but it's important to understand. I'm going to try to keep it as simple as possible and make it as least technical as possible. I've done this a lot. If you've watched my videos, we're going to 1979, we're going to 1980 right here. We got 6% federal funds rate, goes up to 19% federal funds rate. And then from there to 2009, federal funds rate got to 0, right? Which is 0% right here, the bottom line. And then 0% went all the way to like 2021. Ticked up a little bit, and then it's gone up in 2023, right? And that is what it is. So it's important to know that as we're going through this, dividend rates always trail. So I'm going to have green be the interest rate line, or the dividend rate line. Dividend rates always trail the federal funds rate in the bond market. And then, and that means on the way up, dividend rates are going to be less, then it's going to be a worse performance than the federal funds rate. Therefore, you know, how they perform is going to be worse than a bond, or worse than other fixed assets, like savings account, I guess is the easiest way to look at it. It's going to be worse. And then on the way down, when dividend rates are going down or interest rates are going down, dividend rates are going to go down and they're going to trail, and there's going to be a buffer zone. And so when we look at what has happened since 1980, we basically had this crossover point in about 1982, where dividends started being better than savings rates, right? Now, dividend rates don't mean actual return inside of a policy. So right now, for instance, what's happening is we're getting through this period of time where the federal funds rate is going up. And let's say right now the federal funds rate is at 5.5%, right? And what happened was dividend rates are here sitting at around 5.5%. And what's happening is now they're going to probably go up, but we don't know how long it's going to be before dividend rates start going up to catch up. But we're going to have to see what happens with the fixed rate environment as well. But what I do know is that while dividend rates right now on some non-direct recognition companies are maybe 5 to 5.5%, loan rates right now are 5.75 to 6.5% on whole life policies. This is really important to understand, because in the past, what would happen is that we'd have a dividend rate of, say, 5.5%, and we'd have a loan rate of maybe 4 to 4.5%. So this is obviously a really good situation, and this, what we're looking at right here, is basically what's been happening from 2009 to 2022 to 2022, right? We've had this environment where there was this positive arbitrage situation where you could borrow because of cheap money. You could borrow at a less rate than a non-direct recognition company was crediting from a dividend perspective. But even then, the answer is not so clear. The reason is because, and I'm just talking, this is just setting the stage for why taking over the banking function in your life isn't as clean as a lot of these influencers online and people talking about this are talking about. So what I'm talking about here, though, is even though this circumstantially has worked and you've been able to get positive arbitrage, you know, taking over the banking function in your life isn't just about positive arbitrage. It's about leveraging money, having a system, having control of the system. And so the idea, and when you talk to purist infinite bankers, and by the way, you could probably tell I love 95% of it, but I am not an infinite banking purist. And the reason I'm not an infinite banking purist is because of the fact that I just truly believe when you look at life, when you look at all things on a spreadsheet, the reality is there's always a cost to money. Now, control is amazing. Having your money, and the reason I love whole life insurance is because having your money and as much of your safe, guaranteed, liquid, accessible capital inside of a whole life policy simply gives you options. It gives you control to go out and be a better investor, be a better negotiator, be a better consumer. And so when we look at this, let's just use a car, for example. So let's look at the traditional way that people are talking about becoming your own banker. So they would say, hey, go out, get a car, let's say get a $50,000 car, right? Get a $50,000 car, and then you're gonna go borrow from your policy, and you're gonna borrow at 4.5%, and then you're gonna earn 5.2%, for instance, or let's just call it 5%. So this is what they would say. So they'd say, if you could earn 50 basis points on this, and because of the fact that we've been living in this environment right here, it works. Like, you know, from a on paper perspective, you look at the dividend rate, you look at, you know, the loan rate, that all works. But the bottom line is, it's not that simple. And it's funny, I want to warn you, I'm going to kind of tear this down to build it up, because I do love the idea. I do love the concept. But the problem is, I think it's being sold in too simplistic a way that's not fully transparent, that's not fully educational. And as much as I love it, I don't have truths, and I want to make sure that you understand it fully. And so I'm getting into this, and so I forgot to hit this button, but I'm going to go back to over here to hopefully make the visual better for you. So what we have here is, 50,000, 4.5, 5% is, let's say it's a 5% dividend, hypothetically. We're just going to use a fictitious kind of situation here. But there's a problem with this 5% dividend. The 5% dividend is a gross number. If you know anything about income, it's gross income versus net income. Your gross income is the income before taxes and everything else, right? Your net income is income after all the expenses and taxes come out of it. And so at the end of the day, when you look at insurance policies out of the gate, year 1 through 7, you're not going to earn even close. I mean, you'll get the 5% dividend, sure, but then you got to have all your expenses of insurance and all this stuff. I don't really care what the dividend is. I care what the internal rate of return is annually on the policy. Now, the dividend eventually is going to play into that, but you need basically the first 7 years to capitalize the policy where it's going to be efficient enough for this dividend and annualized rate of return and the efficiency of the policy to actually make sense. So the first thing that I have a challenge with is people saying, hey, go in, put $100,000 into a policy, commit to a $20K per year premium, and then you can borrow immediately within 30 days. You can borrow this money or borrow 90% of that money is what they say. Well, first of all, that's not accurate. If I did a front load of a policy and did 100K total my first year, that means I would have done like an $80,000 single paid up additions rider, which is great. And then I would have had a $20,000 a year premium. And depending on the blend of the paid up additions and the base, let's just say I did a 40-60 policy. So out of that, 12,000 of that would be PUAs. So that total would be 92K PUAs-ish and 8K base, which once again, this doesn't account for the fact that 92K would be a little less because of the term rider and all that stuff, but I'm not gonna get super detailed with all that. Just for the sake of this, let's just realize that this is the number, or like let's just talk about these being the numbers. Now, the problem with this is that if you look at the end of the year, because you put 100K into it, it's gonna show you, if you do it right, it's gonna show you about 90K net cash value. So people will say, oh, you got 90K, you'll have access to that within 30 days. Well, the reality is, or you'll have access to 90% of that within 30 days. It's not the case, because when you look at this 90K, that's the number that you have liquidity of at the end of the first year once dividends are paid, right? So the reality is you have to basically, if you want to know how much money you're going to have in the first 30 days, you have to basically look at the guaranteed section minus whatever, the guaranteed column minus whatever the guarantees are, because that isn't going to be credited. That all gets credited later. And then you multiply that by 90%, right? And so in this situation, let's say they're getting 5% dividend on $90,000 there, right? Just stay with me to keep numbers even. Out of that 90,000 that's there, 5,000 of that is the dividends, right? So we have to break down the dividends and take that out, that $5,000. I'm gonna just say $5,000 out, that would be 85,000. And then we have to do 90% of the 85,000 is what you would actually have liquid and available potentially from a net cash value perspective to borrow against in the first 30 days of the policy. It's not this full 90,000 that you have access to. So I think that's really, really important. Furthermore, to take over the banking function of your life and run all your expenses through the policy, once again, that is not what the whole idea of taking over the banking function of your life is about. It's just how some agents online are selling it. So I want to be really, really clear about that. When you look at it like that, you have to look at the net production of the policy, not just the gross dividend rate. So what I'm always looking about is how much did the policy grow year in, year out. So if I put in $10,000 per year, right, in year one, and then year two, I'm putting in $10,000 and the policy's growing by greater then the premium, that's the number that matters from a perspective, because that's where the contract is going to start to become really efficient. That's why I like really highly front-loaded policies, and that's why I like designing policies that will grow by more than the annual premium starting in year 2. Now, that said, here's the deal. The net number is what matters, and you can kind of break it down. You need to learn how to like read illustrations, and that's a part of it. But I want to just talk semantics now and really talk about what the banking function of your life means, because one of the things to me when I think about taking over the banking function in your life, and this is an area probably going to ruffle some feathers here, where I disagree with most infinite banking purists, because the goal of most infinite banking purists is to eliminate the use of banks, because God bless his soul, like Nelson Nash, just was really extreme in that regard. He didn't want to use banks. He didn't believe in banks and all that stuff. I guess I come from a little bit of a different angle. My belief is that we need banks, and it's pretty naive to think that you'll be able to get through life with maximum efficiency without utilizing banks. But once again, like I started the video, the whole concept of utilizing a whole life insurance policy in your life, and what people talk about in infinite banking, is having control of your money, right? Putting yourself in the driver's seat of these financial decisions and having a financial system that you can run every decision through. To me, that's the power of it. And when I don't want to eliminate the banks, I just want to have control over the banks, right? Like, I don't want to be beholden to the banks. And let me explain, because this is going to make sense. So, and I want to say this, I know there are a lot of infinite banking practitioners out there that do agree with me and that do talk about it this way, but I also know that there are a lot out there that don't agree with me. So let me put it this way. So let's just say I had a policy value, I'll write net cash value, policy net cash value, and I want to take a loan, right? And I'll write the loan amount. And then the opportunity is, and loan amount, all right. And so here's the deal. Let's say I have a policy net cash value of 100,000, right? And I want to take a loan of 50,000. Let's just say we're talking about buying this car, because I think that's a pretty common situation. So my options at this point in time is I could take a policy loan, and let's say I'm able to get a policy loan at 5%. Now, I could go out and I could get like an auto loan, like a bank loan, bank auto loan, credit union or something like that for 1.9%. Let's talk this through, because it's really important. I want to make sure that you don't just buy into these clickbait concepts, and that you understand how to utilize this concept of taking over the banking function of your life to actually be a better consumer, right? Because now what's going to happen is the people here will say, well, if you can earn if you're paying 5%, and this is the argument, and this is, by the way, I agree with this argument. If you could pay 5% but earn a 5.2% dividend, by the way, which you will once the policy is capitalized properly after year 7 or so, this will come into play. But if you think you're going to borrow at 5% and earn greater than that in the first 3, 4, 5 years of the policy, I got some, I don't know. You're going to be seriously disappointed. I was trying to come up with something clever. I don't have it without sounding really snarky and rude. So that is what it is. And so we have, 5% loan. So their idea is like, well, you're earning 5% or you're paying 5%, but let's just say you're earning 5% as well, right? So it becomes a wash, right? So their idea is like, this money that you're borrowing against is never going to get interrupted. This full, if you're using a non-direct recognition company, is going to keep growing by plus 5% every single year. And so no harm, no foul. But here's the problem. They say, why would you ever use the bank if you could just do this? Well, it's because there's a cost of money, because at the end of the day, what we're talking about here, when we're looking at, taking over the banking function of your life, you're trying to avoid the bank. I'm not trying to avoid the bank. I'm trying to put myself in a better financially efficient position, and I'm trying to keep myself in control and in the driver's seat for everything. So if I could take a policy loan at 5%, okay, that's great. but that cost is real. It's 5%. I'm always looking at the cost of money because it's a third-party transaction, because regardless, this 100K is going to keep growing at this 5% dividend rate no matter what. So if I then am going to borrow against it, the beautiful part about the 5% with the insurance company is that I can get that 5% on a guaranteed basis very quickly. It's an unstructured loan. There's a lot of benefits to it. Don't get me wrong. There are a lot of situations where I love that. However, they would say, because of all those benefits, you never want to use the bank. Now, in this situation, I would say, what's 5 minus 1.9? It's 3.1. So this loan has 3.1% less interest. So on this $50,000 loan, we're talking 5%. 50,000 times 5% is 2,500. So you got 5,250, right? So you're 52,500. So you're paying 2,500 in interest expense. Now, if I go and I do this and I go 50,000 times 3.1%, I'm gonna just do the math here. 50,000 times 0.031, 1,550. So 1,550. And so we got 2,500 minus 1,550 is $950, right? So we're basically paying $950 in extra interest by utilizing the policy loan compared to utilizing the bank. Now, I do want to kind of throw another wrench in the mix, because once again, the purpose of this is to teach you how to take over and be in control of the banking function of your life. Not necessarily take over and eliminate the bank, but just be in control of the banks that you do have relationships with. Because at the end of the day, this 1.9% may not be equal. I use the example, I went and bought a trailer, a camping trailer that I towed behind my Jeep. And I bought that trailer. The trailer was MSRP of $29,995. So for the sake of this conversation, let's just call it an even $30,000, because that was effectively the MSRP of it. They went out and they tried to say, hey, Chris, it's 30K is the trailer, but we're going to give you a deal. We're going to knock that down. We're going to make it 26K, right? And on top of that, we're going to offer you financing at 4.9%. So if we look at this and we go, ooh, that's a pretty good deal. I'm getting 4K off and they're giving me good financing. It is what it is. Like, this sounds really good. You got to understand that sometimes these loans, unless you're going through a credit union, I would always say, try not to use the auto loans that the dealerships offer you. Go to a credit union and get this, and then go in and negotiate with the dealership cash. Get the financing lined up before you go buy. The beautiful part is you can utilize your cash value in your policy sometimes to collateralize even with a credit union or another bank. And when you have the auto loan and a policy loan to back that up, and when you use some of these other banks that will offer cash values on the line of credit, or cash value lines of credit, they will also sometimes allow you to do that with a car and get you a better rate. That can be an amazing thing that will reduce your cost. You're able to increase the efficiency of your policy and of your long-term cash growth. It's just you, once again, being a better consumer, because sometimes this 1.9% right here that we're talking about is not really a pure rate, because maybe this $50,000 car that would be $50,000, they'll give you 1.9%, but they'll mark the car up to like $52,000, and they'll charge you some extra interest in there. You know what I mean? And so you just have to go in being like, with your money locked in first and knowing what you're gonna do. Like if you're not gonna use the policy loan, go in, set up the loan ahead of time, go to a credit union, and if you know the policy loan's 5%, but you can go to the credit union and get 1.9%, which right now is probably not realistic. You know, that is something to take into consideration. I'm using numbers that would have been used for the past decade, right? The beautiful part about right now where we are is that if you go to a bank for anything, if you go to a bank for any of this, a bank loan is going to be probably 7%, because or they're going to jack the price up on the car, and the policy loan is 5%. So the good news is, as far as even if you don't have positive arbitrage, once again, now what do we have? We have control, because now if you want to go out and buy this car no matter what, and you know you want to buy it, having your money in a policy in an increasing interest rate environment, when bank and auto loans and other stuff is getting more expensive, policy loans are going to be cheaper in this environment. And so they create more leverage to you for you to go out and buy these assets that you would have anyway. But the principle here is to understand how to use the cash value to be a better consumer. And when you take over the banking function of your life, I don't think you should take over the banking function. I think you should take over the banking control, not to try to eliminate the bankers, but to try to use it as leverage to be a better consumer. And if you can ever get the bank money at less than the policy money, then you can always do that. And I know a lot of people will say, well, it's unstructured, and so you're gonna pay more money, or you're gonna have more structure to it. Well, I got news for you. If you ever hit a month in your structured loan that you can't afford it, well, then you can take a monthly loan from your policy to pay off a small portion of that, and you have an unstructured loan for that month's payment of the policy loan that you couldn't afford, right? Of the car loan, auto loan that you couldn't afford. So hopefully that makes sense. At the end of the day, when it comes to this concept and the idea of what whole life insurance is all about, why you want it, I'm a big believer you need to save as much money in the policy as possible. You want to have that as liquid as possible. You want to leverage that money. You want to shop around, use it to control your banking options, because then when I use a bank and I get cheaper money, then when I do anything with that, even if I use that bank and I took the 50,000, I'm never going to default on that because I always have that money here. And if I need to lean back on the policy loan to bail out my other loan, I have the ability to do that. So why would I use that loan to like just eliminate the bank when at the end of the day, I'm always in control of the bank, right? Because here's the deal. If this money, if this $100,000 is going to go up no matter what, and the whole benefit of the policy loan is the fact that it never interrupts that 100,000 from increasing 5%, becomes a wash in that example. Well, if I could pay 2% over here and it's going to grow up 5%, well, that's built in arbitrage. That's how you can kind of bake in arbitrage, but it's not something that naturally happens, right? And so, and it's not something that happens if you just use the policy in your ecosystem. The ironic part about taking over the banking control in your life, as I would say it, is that when you combine the policy net cash value and you add in extra steps of you becoming a better consumer and having better strategies and learning how to negotiate, learning how to like shop better and negotiate different rates and learn how to collateralize it, and you become a bit more sophisticated with it all, that's when you ultimately have control. And that's when in decreasing interest rate environments, you're gonna have different ways to leverage it. And then in increasing interest rate environments, when you don't have the ability to get policy arbitrage here, you can leverage it. And as a consumer, where you're going out where loans would be more expensive, you're able to leverage policy loans for cheaper. And so it's not about positive arbitrage in the policy. It's about if you're gonna buy this car anyway, and you were gonna have to pay a bank a higher rate or a mortgage rate. By the way, mortgage rates right now are higher than policy loans. Think about that. Like, that's insane. Mortgage rates have been so cheap lately that the idea of like, I mean, I can't tell you how many conversations I had with people over the past 4 years where they were like, why would I pay 4.5% for a loan, on a down payment for a house when I can just, just like my mortgages, I could finance 98% of it for, 3%, 3.5%. That's insane. Like now mortgage rates are 7.5%. And so the idea of being able to have a 5% loan from your policy to use as a down payment on a house, which could basically function like a second mortgage and whatever, like it's so powerful. So you just have to understand the different economic environments, the different ways that the policy matches and meets you and supports you. Because here's the deal. This is the last thing I want to say before I go. Is that it's important to understand that as we go through, we have interest rate cycles, right? And this is a really extreme version, obviously, right? And so let's say we have 10% and we have 0%, okay? And this is obviously not to scale, but it's just the concept. What's gonna happen though, and what's important to understand is that when, my phone's ringing. So blip that out if you can. So what's gonna happen though, what's important to understand is that when interest rates are going up, the policy you will use differently than when interest rates are going down. When interest rates are going up, your policy is gonna be leveraged and it's gonna be cheaper money inside the policy than when interest rates are going down. Typically, you can get cheaper money outside, or I'll just write outside, and then I'll write inside, right? So when rates are going up, cheaper money inside the policy than other banking alternatives. And when interest rates are going down, cheaper money is outside the policy. So you leverage third party lines of credit, stuff of that nature. And at the end of the day, if you're young and you're going through this, you're probably going to see many cycles like this, and you're going to go through it, and you're just going to have to learn how to be a good consumer and how to be a good banker and how to learn how to navigate each situation. And my challenge is, I think because the last 10 years, we've been in this situation where, people have been thinking about it just like this bubble where positive arbitrage has existed since the 80s. And I think it's just been artificially created, quite frankly. And I think those times are done. And I think we're past that. And I think we need to learn how this stuff really works and stop just leaning on the easy elements of positive arbitrage because those days are behind us. And quite frankly, that's just not what the whole concept and system is about. And so hopefully you found value in this. Hopefully it helped. And that's it. If you did, like it, share it, make a comment, tell me what you think. Tell me if you have any more questions. Happy to do another video to do a deeper dive. But that's it. Till next time, have a blessed, inspirational day. Talk soon. See ya.